If you are considering investing in a multi-unit building in Chicago, it is absolutely essential that you watch this video first so that I can save you tons of potential time and stress and give you a very realistic expectation of what shopping for 2 to 4 unit properties in Chicago is actually like right now. Not gonna lie, it's a big time challenge out there, but that doesn't mean it can't be done with the right amount of coaching and patience. My name is Jake Lyons, realtor with @Properties and owner of thechicagohomesource.com, bringing you well-informed, data-driven content as always. In fact, if you're watching this, there's probably a pretty good chance that you first encountered me in one of my other multifamily videos where I break down each neighborhood individually. I haven't made one of those in a while, but those got some pretty good traction. This video is going to have some tough love, some things that you might not want to hear. This is kind of like the summary of everything I either have or wish I would have told dozens of past clients sooner. I've worked with and spoken to hundreds of people who are looking for multi-unit properties all over the city of Chicago and some of the surrounding areas, and have seen some very consistent themes of what the challenges are for those would-be investors. And with the right plan and attitude, those challenges can definitely be overcome. The data I am about to refer to is true as of spring of 2023 when I'm making this video. However, I have been closely tracking this space for years, and while the market conditions of 2023 of course do add some different wrinkles like any other market does, most of what I'm about to say has been true in this market segment for years, and I don't really see those dynamics drastically changing anytime soon. If things do change, I'll of course make updates mentioned in the description and things like that. But without further ado, let's get into the meat of this topic. Here are the top 3 challenges of buying a multi-unit property in Chicago right now. Number 1 is the supply is crazy low and the demand is crazy high. Depending on the part of town that we're talking about, new listings are down anywhere from 20 to 45% from last year. At the same time, interest rate increases and a lack of significant price reductions in the house and condo markets are driving even, more and more people to find creative solutions to their housing affordability problems. And the house hack method is a top go-to play for that and is driving more people to the 2 to 4 building market than ever before. The number 2 challenge is that the market is overpriced as a result of those things I just mentioned. I don't have any hard data to necessarily back up this statement, but for the most part, speaking anecdotally from experience in the field, owners of positive assets in the small multifamily space are only selling if they get an outstanding price. It's like a make me an offer I can't refuse kind of situation. Few of them are in a position where they absolutely have to sell. And even if they are, they see what others are trying to charge and they want to try to get that too. So therefore, we are consistently seeing prices that on the surface just don't seem based in reality. That's just the way it is. Buildings that need gut rehabs are priced like they only need cosmetic updates. Buildings that need slight cosmetic updates are priced like turnkey properties. Turnkey properties are priced like new construction. And new construction, don't even get into that. Now, technically, as residential properties, these buildings are valued and appraised by a comparative analysis method, the same way houses and condos are. If that were all that mattered, then these prices might not be so bad, as it would just be kind of a little bit more of like a, if it's worth it to you, then that's what it's worth kind of situation, assuming that the appraisal comes in and agrees. But with a multifamily building, there is a revenue generating component, obviously, and the rents that the building generates have to make some kind of financial sense for the price being paid. And that is where the vast majority of buildings on the market right now fall short. Which brings me to my third point, which is the numbers simply don't work unless you're bringing 25% down or more. If you can come to the closing table with at least 25% down with a conventional mortgage, or pay cash, even better, then that will mitigate or even eliminate many of the problems that we're speaking. The higher the down payment, the lower your monthly mortgage payments. You likely won't have any private mortgage insurance or PMI. You might get a lower interest rate, which obviously helps. And at that point, even the most absurdly priced properties will at least look like they could turn a profit from day one. It starts to make a little bit more sense. Plus, in my opinion, storing money into real income generating assets is always a good move, especially in a somewhat uncertain, high inflationary environment. Now, most of the people who are in the market for a small owner-occupied multi-family property are not bringing 25% to the closing table. These are the people, I come across a lot of people who are looking to take advantage of FHA financing, which allows you to do as little as 3.5% down, provided the property is owner occupied for a year and passes an FHA inspection. While this is a great, fantastic program with awesome benefits when it works, there are many complications that can come from looking to use one of these loans on a small multifamily building here in Chicago. I don't know about any other markets. I'm not an expert in any other market but Chicago. But at least here are my top 4 reasons why using an FHA loan on a small multifamily property in Chicago could create some challenges. One is that the FHA requires private mortgage insurance for the life of the loan. So while I would argue that this is still better than whatever the time it would have taken you to save 25% of a down payment, this PMI will potentially add hundreds of dollars to your monthly payments, making the investment less attractive from a cash flow standpoint. Number 2 is the FHA self-sufficiency standards. If you are in the market for a 3 or 4 unit property, that property must exceed the FHA self-sufficiency standard, meaning that the market rents that a fully occupied building is able to generate must meet or exceed some multiple of the monthly payment. I would tell you what that multiple is, but these things are liable to change. So just whenever you're looking to do this, ask your lender what the situation is at that time. In this current Chicago market, this rule eliminates many buildings from contention right off the bat, especially 3-unit buildings. 4-unit buildings have a much better chance of passing this test because of the added stream of income. Unfortunately, there are precious few 4-unit buildings that actually come on the market. But if you can find a good one, that's make moves on it because they don't come around very often. Third is the FHA inspection. Now, in order to approve the loan, the FHA needs to have a special inspection done to show that there are no safety concerns with the property. I've had inspections where there were little nitpicky items that came up that the seller indeed did have to repair before close. And I've had inspections where they definitely should have pointed out some things, but just didn't. It's kind of a crapshoot. It really just depends on the inspector you get and how busy they are, what kind of day they're having. It is what it is in that point. But could potentially, make a deal go sideways if too many things come up in that inspection that the seller is not willing to take care of. In any case though, it poses a potential risk to the seller that something will come up that creates an added expense or time suck, which takes me to my last big challenge of shopping with an FHA loan, which is FHA loans are less competitive. If there's a hot property, one where things are finally shaping up and the price is right and rents look good, the roof and mechanicals are new, and it's full speed ahead towards making your offer, it will very likely be the case that you're not the only one who's watching for places like this and is thinking the exact same thing. Multiple offer scenarios are still quite common for good properties that pop up, and if you're running up against conventional or cash offers, your FHA offer is going to be less enticing to that seller if everything else is equal. To win in a scenario like that often means paying more than what the others are and trying to convince the seller that that potential added sale proceed would make up for the heightened chance that a deal could go sideways. Other alternative loan programs like VA, for example, will have many of these same issues as well. Enough of the doom and gloom though, you know the problems. Now let's discuss the top 3 ways to overcome these market challenges. Number 1 is have patience. If you're getting into this with a tight deadline to meet on, getting to the closing table, maybe you're coming up against like a lease that's expiring or some other thing going on in your life, the odds will probably not be in your favor. The supply is just simply not robust enough to bet big on your perfect opportunity being there right when you want it to be. Like if you're looking for a condo in Chicago, you can pretty much go from deciding you want a condo to closing on a good quality condo in 30 to 45 days, the whole process included in that. And that just probably isn't so with the multifamily buildings, although there are, of course, always exceptions. You'll likely need to keep a close eye on that market for quite some time and be ready to pounce at a moment's notice if something interesting pops up. Number 2 is submit offers that work for you. As mentioned before, in this market, the prices that sellers are asking will almost certainly make no sense from an actual business point of view. Run your numbers and submit offers that actually do work for you, even if those offers seem a bit bold. If you do this enough, eventually you'll fall into a better deal that works for you. Be aware though that there is more than a little bit of art involved here. You need to know which opportunities might be more or less susceptible to such an offer and how to play it the right way, or else you'll be wasting your time, maybe hurting your reputation. And working with someone who understands all the variables at play with this will be an immense help in that respect. Number 3 is going to be keeping a long-term perspective. This is super important. I could do an entire series of videos just on this topic. I love it. Look, cash flow is nice, okay? Every investor should want cash flow. But cash flow is not the only or even the most important desired outcome of real estate investing. Building equity is the real pot of gold at the end of this rainbow. Now, assuming you're buying in an area with good, strong fundamentals where the asset should have some appreciation, the rents should rise over time, even if you're in the red a little bit each month for the first year, 2 years, however long, as long as your financial situation can absorb that, the equity in that building that you'll amass over time will likely give you a higher return on investment than just about any other asset that you could have been pouring that money into. More than the stock market, more than crypto, more than whatever the latest meme stock is, more than just pretty much anything. That's the power of using debt leverage and using the rents to help pay your expenses while that building gains value. All that is to say, don't worry if the building you're getting isn't a full-on home run. Home runs really don't exist in this market right now unless you're willing to really get your hands dirty with a full-on gut rehab that you pay a bargain price for. Though, as mentioned before, even those can be hard to find. Singles and doubles that's the sweet spot you're really looking for right now. Just getting on base, making sure you're at least not buying a complete lemon, buying a place with strong fundamentals that should appreciate over time, and before you know it, that single will develop into a home run as time goes on. The value of the asset increases, the rents go up while your payment stays the same or even decreases in the event of a refi or something along those lines. So, don't despair. Have patience, have realistic expectations, align yourself with someone who knows the ins and outs of the current market that you're interested in, whether that's me or someone else, and you'll be good.